Live. And welcome to RealAg Live, everybody. Thanks a lot for tuning in. I'm your host today, Shaun. Haney. Really do appreciate you making some time for us here today on RealAg Live. We are broadcasting every weekday, 3 p.m. Eastern, 1 o'clock Mountain, and sometimes we have guests where we talk about topics that are a little bit static, a little bit longer term. Today we are right in the moment of it. We are right on report day here, the report coming out just about 3 short hours ago. And let me tell you, it absolutely moved the market today, and it's phenomenal. Some people calling it kind of a career-type day. They've never seen this kind of movement and some of the things that are in this report. So we're going to break it down for you here today. If you want to participate, would love to have your questions and comments. All you have to do is enter them in the comment box, whether you're watching on YouTube, Twitter, or Facebook. And today's guest is John Driedger of LeftField Commodity Research. John, how are you?
Doing fine, thanks. How about yourself, Shaun?
Hey, man, I'm doing pretty good. And Lindsay says, anything happened in the corn and soybean futures today? Oh, no, nothing. Okay, move along. Nothing to see here.
Move along. Let's talk about something else. Yeah.
Dude, what a day. I'm going to put on the screen here what today's futures market looked like, and it's incredible. We've got corn in the near month up 25 to 491.5. We've got March soybeans up 45 3/4 to 1418 1/4. Unreal. We got Chicago wheat up 30 1/4 up to 665. It's green on the screen across all grain commodities. This is incredible, John.
Well, it is actually. You know, it's funny you mentioned in your opening comments here about sort of a career day or the kind of moves that people haven't seen in a long time. And maybe I'm aging myself by saying that, I do recall it was probably around '08 or something like that when you'd sort of have these massive moves on a regular basis, higher and lower, tremendous volatility. Of course, it was the last time we saw these sorts of prices when you had canola, pushing $700 and those sorts of things. But it's been a long time, right? It certainly has been a long time since we've seen big moves like this, and with a little more frequency, not just kind of a one-off, but we've seen a number of days here. Obviously today is maybe even more extreme than usual, but it's we're back to seeing prices behave the way they do when ending stocks are tight, and every bushel around the margins count, and when some bushels get removed, then the markets respond accordingly in dramatic fashion.
Yeah, for sure. Okay, let's do this. Let's try to break it down a little bit, because there's a lot of numbers. There is a lot of commentary, and some of these commodities, of course, intermingle and mix, but we're going to try to separate it a little bit. What we're going to do is we're going to start with the market leader, which really is corn, and we're going to work our way through soybeans and wheat and see what other direction this conversation all goes over the next half hour. So, corn. I think what catches everybody's attention is another drop of 3.8 bushels per acre on the corn yield. We're down to 172. Amazing, John, especially when we see the increasing demand out there.
Well, yeah, and I think one of the things too that's it's not just the number of it in and of itself, and it's not just the drop from from last month, which on its own is dramatic, but when you think about this whole story, and the same thing applies to soybeans, but as we're talking about corn in the moment, just thinking about where we were at in August, which was not that long ago, and it was sort of deep enough into the production year that you expect some changes or those sorts of things, but just the dramatic change on the production side, not to mention demand, which no doubt we'll talk about here shortly, in a short period of time is really quite staggering. Losing about 10 bushels an acre on a crop like corn, which, I mean, is there a crop and a geography that's analyzed in more detail than U.S. corn production? Probably not. And so to have that kind of a drop in production over again what is a pretty short period of time really is quite something.
Hey, I'm going to put a graphic on the screen here, and this is courtesy of John Newton of American Farm Bureau. I think it really captures the drop that we have seen. Now, this is the shrinking corn crop. This is by bushels per acre by state. And as you just indicated, John, it really, really tells a story.
Oh, it really does. Yeah, it's again just just staggering, I guess, really. And again, in such a short period of time, to have that really taper off. And again, then you back into the implications on the carry out and all those sorts of things. But it's um, it's unprecedented is probably pretty fair way to put it. It's quite something. And again, for a crop being as important as corn is, it's no surprise, obviously, that markets are responding in dramatic fashion.
Hey, question here from Kara. Any comments on why U.S. corn exports reduced with such strong commitment levels?
Yeah, that's a good question. So my thought would probably be this. I think there's a certain element of so one of the things, the corn carryout, was dropped by about 150 million bushels, actually kind of in line with expectations. And so maybe one of the questions you maybe ask is, okay, well, why is the market up so dramatically when really the ending stocks is not that far out from what pre-report estimates are? I think there's an element probably of USDA to a certain extent making the demand numbers fit their smaller production figure. And so I wonder if there's an element of that comes into play. The one thing also on the corn exports, I guess I do have it sitting a little bit in the back of my mind, and I'm not saying that I expect that this will happen, but I do wonder, for example, big commitments to China. Do they take all of the corn? Do you get some cancellations? Do some of it maybe get punted down the road? Those sorts of things. I guess I would always with China, those things are a bit of a risk when there's big commitments and they haven't shipped yet. I'm not saying we expect that, but I wonder if there's some elements of that. I mean, I think USDA has struggled a little bit with the corn import number and dragging from far below what expectations have been in the markets. So I wonder if there's some of those things in play. But perhaps ultimately at the end of the day, it's almost like they jammed a smaller demand number in to fit the tighter stocks, and I wonder if there's a portion of that's also factors in.
Right, and we've got listening today on Rural Radio 147. There's always a lot of market analysts that are cycling through, and like we've got people talking about scenarios in the futures market. Where we open and where we close, and some of the technical traders kind of laying out exactly what the possibilities are here, or things to watch out for. We've got, for the first time in a while, John, people talking about corn with a 6 in front of it and the scenarios to get there. Boy, that's it feels like, honestly, like this time last year we were talking about corn, like what were we, like in the 2s? Like, this is amazing.
Yeah, and I think it's one of the things that, and as we talk, we'll eventually talk about soybeans, we talk about canola, whatever it is, really, I mean, we're in the process for the first time in a long time where markets are really actually forced to like really ration demand, and this isn't just sort of ebb and flow, prices kind of moving higher and lower. This is where markets are ultimately in the position where, we really need to slow usage in a significant way. And I think this is part of where, how quickly the carryout has been driven lower, it's sort of the speed with which that has happened, I think also comes into play. At the end of the day, how does market ration demand? I mean, you drive prices to a level where people use less. Ultimately, people need to be using less corn when they need to be using less, canola or soybeans. How does that happen? By basically making too expensive. But the shorter the window of time within which the demand rationing can take place, it's kind of like the higher that prices need to go. And it's almost like there was this delayed start to the rationing that to happen because people didn't realize that there was that much less corn, and all of a sudden demand shot up. And so you really compressed the window, and it's just, forcing this real dramatic price move. There's a lot of rationing that has to happen in a short period of time, not a lot of alternatives because the balance sheets of almost everything are tight. And then you get these explosive price moves. And so that's really what we're witnessing right now. It's been a long, long time since it's happened, especially across multiple crops. And it's exciting. Now, whether that's good exciting or bad exciting, I guess depends on what side of the ledger you're on, but it's certainly exciting.
Oh, man. Okay, let's move on. Let's move over to soybeans. And, oh, shoot, I got to change this. Just hold on. Bear with me. Producing and doing this all at the same time. Okay, so as I mentioned earlier, soybeans were up significantly today. In the near month, up 45 3/4 to 14.18 and a quarter. What do you think about what USDA said about soybeans?
In some ways, the number of changes on soybeans actually weren't maybe that different than what people were probably expecting in many ways. So production down a shade, not dramatically, but down a touch. Demand bumped up slightly in the exports and in the crush. Again, probably neither of those would be viewed as a surprise. I think the ending stocks and the carryout, again, largely in line with what people are thinking. So in some ways, the dramatic price move on its own probably fairly reflects maybe the carryout that we're looking at and the fact that, demand has been robust, but probably an element of being a bit of a passenger as well in the corn story to a certain extent. But because at the end of the day, soybeans on its own in isolation in terms of what USDA put out maybe wasn't that far of what people were looking for and thinking. Having said all of that, incredibly tight balance sheet. USDA didn't really make too many changes to the South American production figures, so maybe you could that maybe there's a little downside there. In terms of Brazil, they nudged Argentina lower a bit, and so forth. But it's there too. It's not a lot of alternatives. Ultimately, the pace of demand needs to slow, and the only way you do that is by price. But that's pretty hard when China's the primary buyer, your domestic crusher is other primary user in soybeans, and who's going to say uncle first, right? That's a little bit what the market's trying to figure out.
Yeah. A question here from Brian. I have an answer, but I'll let you. You're the guest, John. You can go for it. Can any credit be given to the Trump trade policies with China on this increase in demand?
That's a good question. I would maybe think of it a little bit this way. I think China has been buying it because they need it. Now, to the extent that would they maybe pulled some demand ahead to try and appease phase one and those sorts of things, I mean, potentially you might argue that, possibly, but I think one of the things that would make me feel like they're buying it because they need it is for example, you look at the domestic corn prices just off the charts high, and also they've been big buyers of a lot of other commodities that are not U.S. and sort of not futures traded crops. They're buying canola, they've been buying lots of peas, they've been buying barley, and so if it was just, for example, soybeans from the U.S. and corn from the U.S., maybe you would suggest that was largely sort of phase one appeasement, and that maybe tapers off with new administration and so forth. But one of the things that, again, it's the fact that they're buying a lot of other commodities from a lot of other destinations would be a big part of that. And again, that's not to say that didn't have any impact. Probably some political components of purchasing and so forth. But it's certainly, I'd be cautious to put too much emphasis on that because there similar behavior in other crops that would have nothing to do, for example, with U.S. phase one
and other countries. So
and other countries.
Are we giving Trudeau credit for Canadian peas going to China? Like we've had a pretty terrible relationship with China, yet they're still buying. Back to your original answer of because they need to, and they currently don't feel they have to buy from Australia, but they need to be buying commodities from Canada, the U.S. as two examples. So I think depending on which end of the political spectrum you sit on, there is probably how you feel about the significance of that phase one deal. Anything else? There was production cuts on soybeans in Minnesota, Iowa, and Kansas. Kara Oosterhuis wrote a review story at realagriculture.com that everybody can find. The soybean crush forecast is raised 5 million bushels to 2.2 billion. That's a direct reflection of improved prospects for soybean meal exports with a lower export forecast for Argentina. So South America plays into this a little bit as well.
Yeah, it does. And I mean, obviously, when it comes to soybeans, it's basically on the production side. All that matters is the U.S. and Brazil and Argentina from a broader perspective. I mean, the weather down there has been in the crosshairs for a long time. It seems like the weather has been just kind of good enough to keep the situation settled. You're not really getting big production cuts, but again, when the market's extremely tight around the margins, it makes a difference. I think also as well to a certain extent when we think about U.S. crush, meal exports and oil exports. I mean, just the disruptions have been happening in Argentina. Argentina doesn't export that many soybeans. They export a whole lot of soybean meal and soybean oil. And to the extent that they've had strikes and disruptions and shipments disrupted and so forth, that probably helps U.S. exports for meal and oil. That helps the crush. So it's again, a lot of these things are kind of maybe a little noise and somewhat matter when the balance sheet is a little more cushioned. But when things are as tight as they are, and during times like this, every additional bushel higher or lower has an amplified effect on prices. It all matters and makes a difference.
Okay, let's talk about wheat. Of course, a lot of Canadian farmers thinking about wheat. It's the staple on the prairies. Wheat ending stocks came in lower than trade expectations. Projected 2020-21 ending stocks are reduced 26 million bushels to 836 million. That's down 16% from last year. What do you think about wheat?
Yeah, wheat is obviously it's it doesn't get the same attention as corn and soybeans, but it's one where the carry out is just been trending lower over the last number of months, down nicely from last year. It'll be the tightest carry out since probably about 14, 15, if I recall correctly. It's it doesn't have its same story in as robust a way as corn and soybeans and say canola do, but certainly it's supportive underneath and helps get the tailwinds from the other crops. Uh, Pretty hard to see wheat going a whole lot, trading down as long as everything else is robust. And then again, maybe it sort of catches the tailwinds from other crops, but ultimately, it's not like it doesn't have some of its own story underneath too. Globally, and the major exporters, supplies are not exceptionally tight, but also on the tighter side, Russian exports, probably with their export tax and so forth, tariffs, it's on the tighter side, and certainly helps with the tailwinds of things like corn and soybeans.
Yeah, we got spring wheat in the March future up to 620 and 3/4, and we have spring wheat in May up to 629. What have we been seeing in terms of basis on spring wheat?
Yeah, generally, actually, cash prices in Western Canada have been pretty good with spring wheat. And again, when we get sharp futures price moves, sometimes that basis level can be a little bit noisy. One of the things I think we have also been seeing is pretty wide ranges in terms of buying appetite in some areas. And so you might see, for example, one or two buyers have been really aggressive at times, which have offered some really good prices, which maybe not the whole market is there, but it's been pretty good appetite for wheat, some pretty good selling opportunities. I think, again, especially if farmers can be a little patient, maybe shop around a little bit because it's not necessarily always widespread, but generally the wheat market has been fairly well supported. And say over the last recent bit, we've seen actually a bump in basis, even as futures prices have been moving higher, which you don't necessarily always see. Sometimes that basis kind of helps, buffer those futures gains. But the market's been strong, and so that's been encouraging.
Okay, where do we go from here now? Because this continues to be a woulda, coulda, shoulda. Why did I market all my crop, months ago? I wish I had more inventory and all those kinds of considerations that go on. But how should a farmer with unsold inventory on the 20 crop be viewing things here right now?
Yeah, that's a good question.
Besides
I think
cha-ching.
it's yeah, exactly. Yeah. Yeah. Go for a soccer run for all the inventory you haven't sold yet or whatever. Right. Yeah. It's, no, one of the real challenging things about markets like this is there's no flashing, Bud Light signal or whatever, Budweiser goal light that goes off when the day when the market peaks. Right. And so it's always real challenging to try and determine, oh, should I hold out a little longer, and then all of a sudden you hold it too long and it pulls back. That's a real delicate with this kind of volatility. My feeling is we probably still have more upside to go, particularly since it was fundamentally a bullish report today, and the market again has demand rationing that clearly hasn't. It has more work to do, and so that only means prices at least staying firm, probably going higher. At the same time, it's easy to say, oh, the market's going to go higher when you got inventory in your bin and the value of your crop is swinging significantly from one day to the next because there will be volatility. That's hard to say. I think you probably just one of the ways you manage risk is smaller increments, and sort of reward rallies by maybe just chipping away a little bit, and yet don't. You also want to still leave a couple bullets in the chamber because this market may still have some legs to it, and same with new crop pricing, and
Yeah.
don't get too locked also just into the fact that I sold too much old crop. Well, your new crop is moving higher as well. The farmer is always long. There's always what's left in the bin and next year's crop or even the crop after that. And so don't get fixated on what you sold too much too early, which probably was a good business decision at the time. Uh, and probably smaller increments is probably one way to manage risk in a volatile environment like this, from a practical perspective.
Yeah, for sure. Okay, a couple questions coming in here. Any news on Durham?
Actually, I didn't drill down into the Durham numbers, but we can take a we'll have to take a closer look at that. You might have to maybe tag me or Chuck on Twitter to get
Okay.
some details on Durham. I don't have those ones right at my fingertips, but get market that's been really strong, obviously as well. So
Okay, do you want to provide any perspective on canola while we're here?
Hmm. Well, canola really, it's I mean, a huge update again today. And the one thing about canola is it might have the tightest balance sheet of all these crops we've talked about. It's incredibly tight. The market already for a while has been trying to go through that process of rationing demand, and I don't think that part is done yet. I don't think we're going to ration demand out of the crusher. We're going to have to try and ration it out of export markets. We're trying to ration it out of export markets when there's not a lot of global supply available, and palm oil and soybeans and everything else are tight. So again, I don't know when the day is when the market's done its work, but it's a lot harder to ration demand when everything else is tight. And so that's I guess as I feel about canola, we probably still have some upside as long as everything else continues to move higher, which it seems to. And as I said, it probably is the tightest balance sheet of all of these crops, and so that certainly helps it have its own story in addition to the strength that comes with all these other crops that are providing a strong tailwind as well.
Yeah, we're looking at new crop canola on the futures market November at 547.90. Not too long ago we were talking about how, man, will we ever bust through that 500, that mental
Yeah.
barrier? Of course we got in the near month in January we're looking at 679, but that's a whole nother different discussion. So there is obviously some opportunity here to make some money on the 21 crop. If if you can't figure out how to pencil out canola at 547, it's you're gonna have a tough time, I think, over the long term.
Yeah, no, very true. And one of the interesting things about canola is we could plant quite a bit more next year, and we don't really actually fix the balance sheet. It's not to say that canola can't trade lower than where it's at next year if we have a big crop and big yields and lots of soybeans go in and all the things that could happen. But ultimately, that balance sheet is really tight, and there's room for a big bump in production and not
Yeah.
necessarily make bearish on paper. So it's not just a flash in the pan. I don't think with canola, which again, not saying you can't go lower. You could always build that scenario, but it can withstand a big jump in production and not be bearish.
Well, I think Brian brings up a good point here, and we love to debate the canola carryout, but current prices suggest a much tighter carryout. But the question is, how much tighter?
Well, I mean, I don't think you can possibly really put it really below 1 million tons, I would think, because ultimately, I mean, you think about what you need, even just kind of incrementally keep plants running at all, or just the stuff that sits around in some bins, or, call it whatever you will, that's sort of sitting in a rail car somewhere until that actual harvest comes off, which really, let's just say starting in late August, you kind of need enough to ultimately have about, 3-4 weeks or whatever of supply to bridge that gap, even at a bare minimum. So to push a number below, really much below 1 million, is pretty much zero from all intents and purposes. So it's the work that I think the market is doing on canola is ultimately just trying to get to a level where you basically bludgeon demand somewhere to the point that you keep that carry out at whatever 800, 900 million. Choose the number. It's ultimately trying to bludgeon demand so that that bare minimum is there to carry over. So that's a process we're trying to work through. I think it's going to come out of exports, but a lot of our export demand is fairly inelastic, and so that's where the market.
Oh, you there? Oh, I thought we lost you for a second. Okay. One more question here on canola before we move on. July, November spread at historical levels. Now what? And I guess I would add to that. So do we look that the July future drops, or is it the November future that catches up to where July is? And just to make it clear to everybody, we're looking at July canola at 652.20, and November, like I said, is at 547.90. That is quite the spread.
Oh, it's an incredible spread. It'll stay, at a sharp inverse, probably pretty much all the way through. I mean, in the last, as you get into the tail end, it's hard to say how it's going to ultimately play out. We'll stay at a sharp inverse. And in addition to that, if you look at where cash basis levels are, let's just say your fall basis levels are, called 35 under, or choose a number, whatever your local basis level is, 25 under, and and your basis levels in the cash market for say June, early July are way above that. So on a cash basis, that inverse is you tack on probably another 30 or 40 or $50 maybe on top of that. So it's not just the futures. Ultimately you'll end up seeing cash markets do a lot of the work. I think one of the things as well with canola, with it being so tight, as you get into the tail end of the crop year, you'll probably end up actually having just more buyers just back away altogether, which doesn't mean that the price falls per se, but you're just going to have fewer players in. You're probably, no buyer's going to stick their neck out and speculatively, carry this big position of canola in June, right? They're going to be buying the bare minimum they need to meet commitments and stuff like that. And so it's going to probably be a bit of a choppy and sporadic cash market in the tail end of the crop year because we're just going to be down to fumes.
Okay, so what you said there was sell July calls to buy November calls? Is that what you're saying?
I'd be reluctant, I think, to sell any calls in this kind of a market.
Okay, maybe not the best strategy.
Maybe with your money, Shaun, but I'm not sure if I'm going to put my margin money on to sell the calls.
Says the guy living in like a wood palace. I don't know what's going on there, but that looks pretty nice behind you. Yeah.
Not by selling calls in this kind of market, that's for sure.
Isn't that one of the challenges, though? Is like how brave are you to step in front of this kind of a bull? Right? Like it's easy every week to be like, oh, this is the top. Here we go. Like if you said that 3 rally, big days ago, boy, you are on the wrong side. Like let's say you bought, like you come up with some sort of complex exotic derivative strategy this morning. You were like 30 cents wrong on soybeans, like at 10 o'clock this morning. Like it's crazy. How the size of the moves and those margin calls will they'll give you a headache. That's maybe the light way to put it.
Yeah, no question about that. And that's where it certainly sounds a bit boring and a bit mundane, but something as simple as chipping at some put options, they're probably not cheap. It's not maybe the fanciest strategy. But at the end of the day, you don't have to worry about margin calls. And yeah, most of the times I wouldn't, worry about margin calls. And yeah, I understand that, if you get margin call, your cash canola is going up and all that kind of stuff. It can be painful in the interim, and especially in a market like this, so it's in most market environments, I try and encourage producers not to be too worried about margin calls per se, but this isn't most market environments. Certainly this is a bit of a different playing field than we've had in a while.
Follow along, Lindsay. I'm telling you.
I think we just got a shot there from one of your own people.
I know. There's just no respect around this place. Like a typical sheep farmer, she's thinking about all the things that can go wrong. Any stinkers right now? Too much good news makes me nervous.
I don't know if there's any stinkers per se. It really is an element of rising tide lifts all boats, and there's some truth to that, even if it's a bit of a laggard. And even a conversation I had with a client this morning talked a little bit about, what about yellow peas? And if prices don't keep up, they'll start falling out of some rations, and so or some rotations, and that maybe helps pull pea prices up a little bit and so forth. But Lindsay's right. Markets always look most bullish at the top. All along the way, and this was even earlier on in the rally, we've sort of had our antenna up for signs of cracks in the armor. Our basis levels falling apart, our future spreads weakening, or we seeing prices maybe fall apart in other geographies and those sorts of things. I mean, those are kind of the red flags that we'll be watching for signs of when it maybe is running out of steam. Not really seeing those yet, but it's but Lindsay's 100% right. When there's too much good news and everything always looks most bullish at the top. We're friendly based on everything we've been seeing, and yet I do not say that complacently. I think we got to have the antenna up.
Yeah, I know you're starting to work on your. Well, Chuck gave a presentation this morning at the Saskatchewan AGMs for the crop commissions, and I had a slide shared with me breaking down the money per acre and kind of where the money is by crop type. Kind of applies to Jeneth's question here. Do you expect wheat and barley prices to drag oat acres in 2021?
Yeah, I think it's actually a good question in there too. I think it's going to vary a bit by region, but it sure sounds so. In our opinion, we're going to probably see a pretty good drop in hard red spring wheat acres. I just don't think that. Now, having said that, I mean, you see a move like we did today, and maybe that changes. One of the things we're seeing is just as markets move around and change as quickly as they do, suddenly a gross margin calculation that's a week or two old suddenly looks stale. But I think ultimately we're going to probably see lower hard red spring wheat acres. Think barley acres could be up a little bit. Oat acres, think we'll probably see them probably flattish in our opinion. And I think there's an element of the fact that ultimately I think all those markets are tight enough that they aren't going to want to really give up ground. I think all of them are giving a good enough price signal to farmers to kind of at least sort of hold their ground, which again, I think hard red spring wheat loses some ground. I think that's where you pick up some durum acres, you pick up some canola acres and so forth. But, it is one when the prices of everything is strong, I think it also helps farmers to kind of keep rotations, having some confidence that they can still make money on, maybe it's not the home run crop, but if you can be honest agronomically and not cheat your rotation and make, good decisions on that side, and know you can still make money on the market side. At the end of the day, it's probably better for profitability than pushing too hard on a rotation and then running maybe into some risks on, disease or those sorts of things. So I think that also helps crops kind of keep their ground almost, if you will, a little bit. Yep. when everything is stronger, right? So
absolutely. Good question from Brian. One last thing on canola. Fund positions are flat. Are commercials buying futures to stand for delivery on?
I've been heard actually that there were some deliveries, a decent chunk of deliveries taken in the January. So there could be some of that's going on. It's whether a company actually stands on delivery or not. There's a lot of layers to that, because each company is different in terms of whether it makes sense and are you going to try and supply for a crush plant or not, or that sort of thing. Ultimately, the delivery process for canola futures is not the easiest way to kind of source physical canola. So I think that probably, it's kind of intended that that's not a great, easy, convenient way to source physical canola. But having said that, when the market's really tight, there is maybe a tendency to see more actual companies stand for delivery. I think we saw a decent chunk of that in January, and we could continue potentially see that here going forward. Again, just sort of helps keep things squeezed on the front end.
Something that was identified by, I believe it was Arlen Suderman of StoneX, and Kara wanted me to ask you about it. Soybeans saw a 30-cent increase minutes before the WASDE was released. Any inkling on what happened on that?
Maybe Trump took care of a few of his friends before the numbers came out. I don't know. No, it's no. I mean, the markets have been maybe up a little bit. You maybe get a little bit of momentum coming in. I mean, you might speculate in conspiracy theory. You might say, maybe some numbers got leaked or that sort of thing. I don't know. It's sometimes you can catch a little momentum going into the report. I mean, one of the things we did see, and again, maybe you start looking too hard for reasons why market makes a move. I mean, US dollar was up and rolled down a little bit, stuff like that. Crude oil was up, so it could be a couple of those things as well. Maybe some positioning ahead of the report, or it could just be the fact that maybe just a bit of momentum coming to the numbers being released, which is the market's been high, the markets have been strong, and you're going to have some sizable swings in prices, sometimes for what seemingly isn't, no explainable reason on any given day. So,
perfect. Hey, John, greatly appreciate you joining us here today on RealAg Live. And if you missed any of the discussion, everybody out there, we will be posting this like we do every day at realagriculture.com. You can find the archive at realagriculture.com/live. Hey, John, thanks a lot for joining us here today.
Hey, always fun, Shaun. Appreciate it.
Want to mention to everybody that tomorrow the guest will be Crystal Mackay from Loft 32, and make sure you tune in to RealAg Radio on Rural Radio 147. We are live today. We got great guests. We'll be talking to Association of Equipment Manufacturers about the 5 machinery trends you'll see in 2021, as well as David Shednovic from CN Rail talking about grain movement, and Matthew Pott from Grain Perspectives to talk about the markets. Thanks everybody for getting real and getting connected with RealAg Live. We'll see you again tomorrow. Cheers, everybody.